Thank you for taking out time. It's been a tough 2 months, and after that, April, we have seen at least some bit of good news coming from the rural side, some good numbers coming from the two-wheeler sales. And I think Muthoot Capital's Q4 performance and the full year performance more than reflects the positivity that's going around, especially in the rural economy and two-wheeler sales. So I think without spending more time on this, I will directly hand it over to Vinod, who is the CFO. He'll take us through the performance for the quarter and for the full year, and after which we can have Madhu, who is the CEO, talk about operations and about the trends and all other relevant things. So over to you, Vinod, sir.
Good evening, friends. Good to be with all of you again. Very happy to actually announce the stellar set of numbers. I think today when we actually announced the numbers, or the numbers were approved by the board, we felt very happy, and then we were very eagerly waiting to share these numbers with you guys. On a top, maybe just to put the numbers in their perspective, we had a total disbursement of about 594 crores. On compared to the immediately preceding quarter, we grew by about 13%. Versus the same quarter last year, we grew by about 41% when the numbers were about 423 crores. We ended the year with an overall AUM of over 2,238 crores, and which is a growth of about 13% quarter on quarter and 56% year on year. And based on this, the interest income that we generated in the quarter was about 119 crores versus about 105 crores that we did last quarter, and about 80 crores that we did last year. So versus the last year, the growth is about close to 50%. The finance expenses compared to the immediately preceding quarter grew by less than 1%. It was more or less at the same level as last quarter. Versus the similar quarter last year, the finance expenditure grew by about 25%, and that time the number was close to 25 crores. This time it's about 32 odd crores. The net interest income grew by about 18% in the current quarter and 60% year on year at 86 crores in the current quarter. The operating expenses was at about 3% higher than the immediately preceding quarter, but about 35% higher than the same quarter last year. In loan loss provisioning, we made a provision of about 10.6 crores versus 7 crores that we did last quarter, and about 5 crores that we did last year. Don't panic too much. I will come into it in detail and explain it in detail. This we had a total net profit of about 21.5 crores after tax versus the 15.7 crores that we did in the preceding quarter and about 11 crores that we did in the same quarter last year. Just to touch upon the loan loss provision, this quarter we have actually made an additional provisioning of about 4 crores to move from a 27-28% provision coverage ratio to about 35%. This is something which has been told to us by most of our friends in the investing fraternity, saying that you need to possibly see whether you can look at increasing your provisioning. On a year-on-year basis, we have grown steadily. We had grown steadily in the first 3 quarters, and fourth quarter was no exception. So on a full year basis, we had a total growth of about 56%, I said, in 52% in the terms of disbursement, and about 56% in terms of loan book growth. We grew from about 1439 or 1440 to about 2238. The net interest income from about 284 crores went to close to 400 crores at about 398 crores, a growth of about 40%. The net interest interest expenditure moved from about 104 crores to about 122 crores, a growth of about 18%, which led to a total net interest income growing from about 180 crores to 275 crores, a total in growth of about 53%. Operating expenses was higher at about by 42%, at about 159 crores for the full year. Loan loss provisioning was at 33.6 crores versus 22 crores that we booked last year, leading to a growth of about 52%. This includes the additional provisioning of about 4 crores. All in all, the PAT was at 53.7 crores versus the 30 crore PAT that we did last year, growth of about 78%. The area which bothers most of the analysts is the OPEX to net interest income ratio. In the current quarter, we have achieved a number of about 49.7%. Same quarter last year, it was close to 59%, and immediately preceding quarter was at about 57%. Year on year, there is a 4% drop from about 62% on a full year basis, from 62% to about 58%. The return on assets for the quarter was about 4.9%. For the full year, it's 3.6%. The EPS for the quarter is 13.1, and for the full year, it's about 36.4 per share. That's the numbers. Maybe I'm requesting Madhu to say a few words before we hear from you guys. Thanks.
Yes, thank you, Vinod. Good evening once again. I think over last 1 year, we've been consistently telling market what kind of headroom we had in the two-wheeler market. We exploited that with the help of geographical expansion on one side, and second, a lot of digitalization came into our process, because of which we were able to not only improve our service level at the ground, but at the same time, the productivity levels of our team went up. So one of the contributor to lower cost-to-income ratio has been how, within the limits of the manpower that we have, how we have shown the growth of 50% plus. So we exploited this expansion and the headroom that we had. In terms of expansion, North and East market is where we almost doubled our numbers compared to last year. Although the base is lower, but we have been able to actually enter into almost all the states in the northern piece and eastern piece, and this year again, we believe that we would be able to further expand in these areas. The benefit of having distribution through our parent, through our flagship company, Muthoot FinCorp Limited, also showed up in our results. The business which our flagship company sources for us grew by almost 56%, which contributes about 18.5% of our overall disbursement. That also contributed in a big way, and without additional cost of distribution and expansion, we got business through them. I think overall, in terms of getting the business from the optimal cost is where our focus was, which we were able to kind of leverage. Last call I said operating leverage we have, which we need to exploit, and which we demonstrated this particular year, and that's why we've been able to tame our costs and show the top line and bottom line both. I think if we have to open it for the Q&A, or Vedant, if you want to take it forward, over to you.
Yeah, I think we can start the question and answer session then.
Sure, thank you very much. We will now begin with the question and answer session. Participants who wish to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Anuj Gupta from Perfect Research. Please go ahead.
Yeah, good evening, sir. Hello.
Good evening.
Yeah. So, there are a few questions. So, one is, what is the growth rate from the new regions entered and from the existing regions? And also, if you could provide growth rate for our different products offered, like two-wheelers and three-wheelers.
So currently, we are, as far as asset finance business is concerned, we are only in two-wheelers. So two-wheeler growth had been 55% plus in terms of disbursement, in terms of book. In the new areas where we have expanded, the growth had been more than 100%. So that's what I, in my initial talk, I said that we have almost doubled our numbers in these areas, which we have done actually.
And sir, how are we dealing with the competition faced from other players, as there are many players, including new players like Reliance Capital, who are getting aggressive?
So what happens is, what kind of customer segment that the company is actually targeting? As a vision, we focus on BOP, bottom of the pyramid customers. Our distribution network, our products, our schemes are designed to tap those customers, and that's why. And we are in centers where the competition has not even reached. So, given the spread, given the distribution, given our own captive branches, which is there to source business for us, we feel that there is not much to worry about competition. And secondly, people like Reliance or any other company focuses on, metro cities, tier 1 cities, state capitals, and they compete with, banks and things like that. And we say that is not the customer base we are focusing. We are focusing, our vision says that we are focusing on the common man of the country, and it is the BOP. Entire energy, entire distribution network is focused towards that. And to tie everything together, we have set up our digital process, mobile apps for sourcing business. So this is how the strategy of the company had been. And if you ask me whether I want to compete with Reliance or HDFC, I would say no, I don't want to compete with them.
And, sir, what is the current market share of our company and also the addressable size of opportunity for us in the market?
Can you come back again and can you be a bit louder, please?
What is the current market share of our company and also the addressable size of opportunity for us in the market?
So current market share is about 1.7% of the total sales of the country. The total sales of the country is about 2 crore 3 lakh two-wheelers. Our market share is 1.7% as of now. Of the vehicles which is funded in this segment, our share is about 5%.
Okay, so from the funded vehicles, we have a 5% share.
Yeah.
Okay. And sir, any comments on the size of the opportunity we have?
See, the headroom that we have is clearly from a couple of things. One, the financing piece is about 35% of the total sales of the two-wheelers. So there's an opportunity here that next couple of years, this 35% may go up to 40%, 42%. Point number one. Point number two, there is an increased shift of sales from urban to tier 3, tier 4 cities where we are a significant player. And the market is moving towards scooterization. From motorcycles, the rural market or the tier 3, tier 4 cities used to buy motorcycles. There's a shift to scooterization. So these are the big opportunities that we have, and we are very much, well placed in these locations to tap this particular opportunity. So I'm saying that if I were to extrapolate that what is going to happen next couple of years, I think whatever we have done last year is something which next couple of years we are very confident that we will be able to replicate.
And so the last question is, which areas are we looking to grow further in?
Currently, we are in 16 states. We have already reached. Now the strategy is how we, add additional at least 70 to 80 districts in these areas, in the 16 states. So this financial year, we intend to add at least 90 districts across the states where we will start our business.
Sir, and also as in like for further growth, so as in are you looking to expand into any new products?
Yeah, so we are currently piloting second-hand car finance. We have already launched a couple of months ago. Around Q2 is where we'll be spread out across at least 20 to 25 centers as far as second-hand car finance is concerned. Q3 around that we'll be into a couple of more products, which maybe around at the end of Q1 I would be able to tell you, but definitely PL is something which we are looking actively into, personal loans.
Okay. Thanks a lot, sir.
Thank you.
Thank you. Next question is from the line of Kashyap Zaveri from MK FinCap. Please go ahead.
Hello.
Hello, Kashyap.
Yeah, thank you very much, sir, and congratulations for a great set of numbers. I have three questions. One, in our presentation, we usually give this, collection charges paid out to the agency. If you can give me that number for the quarter. Second question is in terms of FY19, what would be, our, growth, basically what kind of growth we are looking at. And three is that if I look at now your margins, we are probably working now at almost like, peak net interest margins, do you see that, with the rates rising and, the way, the competition, is there any threat to those margins at this point of time?
First, Kashyap, what was your first question? Sorry.
We usually in presentation give out this, collection agency payout. What was that number for this quarter?
It was at 3.6%, not collection agency payout. The entire collection cost was about 3.6%.
3.6% of the closing AUM.
Of the total amount collected.
So what is the absolute number?
Absolute number of collection expenditure for the quarter was about 12.3 crores.
Okay, and this
it's
number
it's a combination of collection agency charges. It's a combination of the amount that we spend on NSCS. It's a combination of several other things. All put together, it's about 12.3 crores. It was at about
11.2 crores in the previous quarter.
In the previous quarter, it was 11.2 crores.
Okay, yeah, sure.
Second question was on the
growth.
Growth in the current quarter.
No, I mean, what's your outlook for next couple of years?
We are fairly reasonably confident that this trend will continue, and we should look at reasonable growth. Similar kind of growth. Let me put it that.
Okay. And third question is on margins. We are virtually like at on a 2,000, slightly less than 2,000 crore AUM. We are at about 80, 85, 90 crores of NII. That works to almost like about on an annualized basis, almost about 16-17% NIM. Do you see any threat to that number?
It comes to about 18%. We are reasonably confident that we should be able to maintain the numbers, because last quarter, in the fourth quarter also, when we met the friends like you, the constant query was on whether there would be hit on the margins because the interest rates are going up. We felt that no, we are growing as an organization and becoming much more stronger, which will help us maybe get funds at a lower rate. Or at least maintain the cost at which we are borrowing, which is what you can see in the current quarter number.
Okay. And so, I don't have the presentation right now, but can you give me the closing gross and net NPL number?
Closing?
Gross and net NPA number.
Gross and net NPA number. Gross NPA was at about 88 crores. Net NPA was at about 50. Sorry? 55 or 58 crores.
Okay. Thank you very much, sir.
Welcome, Kashyap.
Thank you. Next question is from the line of Dhiral Shah from Asit C. Mehta. Please go ahead.
Yeah, good afternoon, sir, and congratulations for the good set of numbers. So what is your average ticket size?
Average?
Ticket size?
It was 56,000 in this fourth quarter.
56,000.
The LTV. And LTV is about 76%.
Okay, 76%. And so what is the current, branch network right now?
It's Nirav, a small correction. I wrongly said 56, it's 53,000.
Okay,
I stand corrected. I'm sorry about it.
Okay, no problem, sir. And so what is the current branch network right now?
See, let me put it this way. Our business doesn't happen through branches. While the flagship company, Muthoot Capital Services, is about 3,500 branches, and we source business from roughly 2,200 out of them. Our chat is about 18.5% of our total sourcing. The balance, about 80-odd%, 81% is done through the various dealer points where our employees are sitting. So that is roughly about 3,600 directly and indirectly.
Okay. And so what is the percentage of borrowing from bank?
Percentage of borrowing from bank in Q4, it was about 62%.
Okay. So is it coming down, or is it?
It has been coming down. We see it coming down further.
Okay. And so what is the guidance for loan book growth for next 2 years?
We expect the trend to continue. If God willing, everything goes as per our plan. We had maybe committed a number of roughly 3,500 crores by 2020. We hope to be there.
Okay, loan book, right?
Yep.
Okay. Thank you, sir. That's it from my side.
Thanks, Nirav.
Thank you. Next question is from the line of Ajay Khandelwal from Bank of India Mutual Fund. We seem to have lost the line. We move to the next one. Next question is from Sangam Iyer from Shipcom Ventures. Please go ahead.
Yes, sir. Congratulations on a great set of numbers, sir. So my question first is just a small clarification. The 3,500 crores that we are talking about is by March 2020?
Yeah.
Right, sir. Okay. Yes. Sir, just going back to our borrowing mix, if you see, from last year to this year, as we had indicated earlier as well, we have brought down our overall bank borrowing from 80% to, around 60% kind of a levels. So, while, CPs have moved up to almost 10% currently, how much leeway do we see in terms of this borrowing mix as an optimal mix over the next 2 years, which can help us sustain or reduce the cost of borrowing from here on?
We are a deposit-taking NBFC. Today, the deposit that we have taken is roughly about 82 crores at the end of the year. There is, we are permitted to go 1.5 times the net worth, which is currently close to 400. So let us say I can borrow up to 600 crores.
Right.
So that's one area that we are seriously looking at, because if I can actually borrow, I can borrow at sub 8%. So if that's an option which is left to me, which we are definitely looking at. But apart from that, if I not want to look alone.
Yes, sir.
If I don't want to look at that fully, if I want to just carry forward from where I left at the end of Q4, maybe I would I can stick my neck out and say that maybe end of the year we would try and get the bank funds to about 55% from my 65%, and try to ensure that there is a much better mix. Maybe we can do a bit more on securitization. I think the options are unlimited, and whatever it takes to ensure that we can keep the cost down, we will do.
So, sir, from an overall perspective, how should one be looking at the cost of funds incrementally going forward? This quarter we did have the benefit of the fundraising as well. So, on a normalized basis for FY19, how should one look at the overall cost of funds, given that the mix is changing more favorable to lower costs?
We hope to maintain the cost, if not reduce it. Let me put it that way. So, we did get the benefit of the QIP, but that wasn't the money came in the last quarter. And post that, in the current quarter, we have possibly reaped the benefits of that in the sense with a lower capital adequacy, with a higher capital adequacy and a lower debt equity, we could possibly go and ask for something better from most of the lenders. We continue to get that. And with the support from all of you, with the strong set of numbers that we have been able to deliver, we hope that this trend will continue as we go forward into the current year and maybe into the next year as well.
Right. So, sir, given that, our mix is changing and also the full year benefit of this will come through for us at least. So, to that extent, can we see another maybe 10 bips or so, 10 to 15 bips reduction in cost of funds coming through for the full year average for the next year?
No commitment. I'll leave it at this.
Okay, no issues. So, sir, one more question on from my, in terms of the overall loan book mix, as talking about the new products introduction, the car financing as well as the personal loans, etc. So, when we move into FY20, how should one be looking at the overall loan book mix for us? And given that these two products would be lower in terms of the yields as compared to your two-wheeler loans, what's the endeavor in terms of an optimal mix that you would be looking at so that we maintain our, the NIMs calculated at the current levels, which is the endeavor that we had mentioned earlier?
So, there are two parts to reply to your question. One, that if you ask me what is our projection for 2020 from other products other than two-wheeler, it would be around Q1 or Q2 that I would be able to tell you. And this 3,500 book that we are talking, it is only about two-wheelers. Okay, that is two-wheeler book.
Okay.
Existing products. So anything what we launch and it grows in up till 2020 would be additional to 3,500.
Mm-hmm.
In terms of, how we select a product and what are the products that we would be keen in doing, we are guided by two things. One, who is our customer or what is the customer base? So we are focusing absolutely on the bottom of the pyramid customer. And that's how, the group's philosophy is, group's vision is, our distribution network, our branches are aligned to this vision. We are driven by customer, what they need, what is their next aspirational product. So, those are the products that we think of launching. The second and the most important guidance to any product launch is that in terms of ROA and ROE, is it in line with our overall financial strategy? If our pilot, if we are convinced that this product is delivering this, then that product is something which will grow in a big way. So these are the thought process that is there as far as any new product that we launch is concerned. We believe that second-hand car is something which is the next aspirational product for our customer base. You should know that for the customer segment that we are talking about, whether he buys two-wheeler or car, it is actually part of his business model. It is part and parcel of his earnings. So that's one of the reasons why we believe that our portfolio quality had been much better than what had been in the market for our competitors. So these are certain guiding forces that we look into, we consider before launching any product, and around Q2 we would be able to kind of give a feedback on how new product portfolio would look like by 2020. But let me assure you that there would be at least two more products besides two-wheelers when we look at 2020. The numbers I can share maybe around Q2.
Great. And sir, given that our OPEX is not going to go up in the same line in terms as our overall loan book growth, which we envisage to go at the current pace itself. So, is there a target cost-to-income ratio that we have in mind in terms of how should one look at it?
On a full year basis,
on a full year basis.
On a full year basis, we would be happy if we can be at about 55 or just below that.
For the next financial year?
On a full year basis, yeah. Because there would be blips in the certain quarters, fourth quarter will look very attractive, but then one should not read too much into it. I think one should look at the full year picture.
Got it, sir. Got it. Great, sir. Congratulations and all this. I will go back to the queue.
Thanks, Sanjay. Thank you.
Thank you, sir.
Thank you. Next question is from the line of Rajiv Pathak from GC Investments. Please go ahead.
Hello, sir, and congratulations for a very good performance. Sir, just to add on this cost side, so now our operating cost average is something like 40 to 43 crores a quarter. So what is the kind of inflation that we take in this number going ahead?
Rajiv, thanks for the congratulatory messages both by WhatsApp and now orally to us. Now let me put it this way. Operating expenses, the major expenses are, let me put it this way, are variable in nature because there is a big chunk of collection expenditure which is directly linked to our the amount that we collect, and second is the sourcing. So let me put it this way: out of the let us say 40 to 43 crores that you actually mentioned, roughly about 12-13 crores is collection, and maybe a similar number here would be the sourcing. Now that is directly linked to sourcing. So when the volume sourcing was 7.5 crores in the quarter. So if that goes up, the cost will go up. So these together itself is about 50% of the total cost.
Sure.
So others you should safely assume the inflation rate, nothing beyond that.
Right. So if I just look at your sourcing cost, it has actually grown at a lower. Your sourcing cost is actually. Hello. Can you hear me? Hello.
Mr. Panic, this is the operator. I'm sorry to.
Hello.
Mr. Panical, can you hear us?
I can hear you. I think we have lost Rajiv at it.
Hello?
Yeah,
audible? Yeah. Okay. So if I look at your sourcing cost, 7.5 crores kind of a number, now this has actually grown at a lower pace than our overall AUM growth. So, is it this like a 1 quarter phenomena, and should we just assume that this will, grow probably mostly in line with our volume growth?
See, let me put it this way. There is a specific formula basis which the sourcing expenses are incurred. So if somebody doesn't meet the slab, then he loses everything. So maybe Q2, Q3, which are attractive quarters for as far as festival and other things go, the sourcing costs are higher because you would end up with schemes and things like that. In Q4, you don't have much, don't do all these things. Therefore, the cost looks lower. But I think while the loan books went up by, I would say, about 50 to 53 crores, 50 to 53%, the sourcing cost has gone up by about 48%. So it's more or less in line with that.
Okay. So full year you are saying that we should, look at 55% kind of a cost to income.
Yeah. We will be, what I said was we will be happy if we can be at 55 or something.
Okay. And sir, if you look at our overall mix, now South is around 81% of the total mix. So going forward in next year, where do you think this mix can stabilize? And another part was on the Western front, where you have seen slightly higher than normal NPAs versus the other three regions. So do you want to keep focusing on that region, or what is the strategy over there?
So the strategy is, how to build a business in the non-South. North and East, we've been telling that it is growing. Now, actually, we have a good book there, a sizable book there. The growth had been quite remarkable. Like, we've been doubling the book year on year. As far as West is concerned, the NPAs that you're seeing is basically some legacy issues which had been there a couple of years ago. there was some issue in a particular area. So that is not reflective of the entire West book actually. West book is good, barring one particular location. And I'm, clearly telling this because West is the area where we want to grow.
Okay.
We grow in, we have very solid branch network in Gujarat. We have solid branch network in Mumbai. We have solid branch network in, suburbs of Mumbai. So we see that there's a huge opportunity within the captive branch setup itself. So we'll grow West. So the NPAs that you're seeing is nothing to be worried about as of now. And that would get cleaned up as and when, the collection happens. So you'll see South coming down. We want it to strategically come down below 80%, below 78% next this particular financial year, and it would come down. It would come down as we expand into West and North.
Okay. And what is the kind of normalized credit cost that we should take now?
See, over the last 3 years, it was about 2.2%. This year, if you leave out the voluntarily charged of 4 crores to P&L provision, it comes to roughly 1.87%. Which is something which we have been committing for a while, that we will be sub 2%. I think we should safely assume sub 2% as we go along.
Okay. Okay, thanks a lot and all the best.
Thanks, Rajiv.
Thank you. Next, we have a follow-up question from the line of Kashyap Zaveri from MK Fincap. Please go ahead.
Yes, sir. This is related to your earlier, reply to LTV and, the ticket size. At 53,000 rupees and 76% LTV ratio, this comes to, the asset financed value of about 70,000 rupees. Now, if I look at the total sales of motorcycles or two-wheelers in India, in that bracket of 70,000, there is a fairly low population of bikes which would be sold in that category. So let's say out of, probably, I have data pertaining to FY16, out of about 10 million or 11 million odd vehicles, there is about, more than 70% which is in economy and executive, where there are fairly few products which are in 70,000 rupees, category. So how come it's so high? I mean, the value of asset finance is so high at 70,000. Hello? Hello?
Participants, please stay connected. We seem to have lost the line for Mr. Panikar. Please stay connected while we reconnect the management. Participants, thank you for patiently holding your lines. We have reconnected the line for Mr. Vinod Panikar. Over to you, sir.
Hello.
Yes.
Sir, did you get my question or should I repeat?
No, you need to repeat because I think it was dropping every minute.
Okay. So what I'm saying is that our ticket size is, 53,000 rupees and LTV is about 76%. So the value of the asset financed by us would be about, 69,500 or 70,000 rupees. Now, if I look at the total motorcycle sales in India for the year, and even if you were to sort of include the scooters part, about 76% of the total vehicles sold are in economy and executive segment, which barely has, which has very few products which are 70,000 rupees ticket size. So I'm just trying to understand, how come our, the value of the asset that we finance is about 70,000. It should be much lower, right?
See, LTV as far as two-wheelers is concerned, they calculate on-road price because there is a road tax, there's an insurance, there is accessory, and then in between there would be revision in prices and things like that.
Okay.
So the unlike cars or commercial vehicles where you look at ex-showroom price and deduct the discount and then calculate the LTV, in two-wheelers it is on-road price actually.
But in, let's say, economy and executive, there would still be very few products which are on-road more than 70,000 rupees ticket price, right? On-road price of 70,000. Would you be able to give me a flavor as to, in terms of the total, AUMs or disbursement that we do, we have done in let's say, FY18, what is the, the OEM-wise breakup and, probably if you can name top 5 models that we have financed.
Kashyap, I think we need to get offline. Maybe
let's do that, yeah.
Send out a mail. We will address it separately. The details का problem नहीं है. एक आध दिन लग जाएगा. निकाल के देंगे.
Sure. No issue, sir. Thank you very much, sir. That's the only question I had.
Thanks, Kashyap.
Thank you. Before we take the next question, a reminder to our participants that you may press star and 1 to join the question queue. Next, we have a follow-up question from the line of Sangam Iyer from Shubhkam Ventures. Please go ahead.
Yeah, sir, do you have any target for PCR over the next 2 years in mind?
Target of the?
Provision coverage ratio. Now that we have increased it in this quarter for this financial year, is there any targeted provision coverage that we have in mind?
Yeah, my friends in the investing fraternity have been suggesting that we need to move to a 50-55%. So over the next 2 years, I think we would ideally want to go to at least 50.
Okay.
That's the intention.
Okay. Great, sir. Thank you.
Hello?
Yeah, go ahead.
Yeah, this is Digant this side. I think we still had 5 minutes, so I thought I'll ask 2 questions which I had to. So sir, the first question was that, this year we had, really great two-wheeler sales. Probably India created a world record by selling more than 2 crore vehicles. So for us, if we have to dissect growth in terms of, how much growth comes from, the general increase in two-wheeler sales and how much growth comes from the penetration driven and, like you are entering new geographies as well as you are activating more Muthoot FinCorp branches. So if we have to bifurcate that and if I have to even think that in FY19 and FY20, let's say the industry growth is not so great as we saw for this year, then, then how much can this penetration-driven growth and activation of Muthoot FinCorp branches help us grow faster than the industry?
See, Digant, there are 2 important things here. One, that the FinCorp branch business is our own sourcing business. We source that business. We have about 75,000 walk-ins daily into this number of branches that FinCorp has. So, if you ask me whether we should be compared with any other player in the two-wheeler finance market, I would say please don't compare us with them because our distribution network, our sourcing capability is totally different. Our customer base is totally different. So if you ask me, is market going to impact us? I would say it may impact, but we have our own capability in, sourcing the business, which otherwise do not go to the dealership for buying the vehicle. They are the customer who walk into our branches and our team converts them. So about 18.5% business comes from non-dealer kind of tie-up. So that is one leading indicator. The second one is that our major business comes from Tier 3, Tier 4 cities or rural areas. Okay, so reaching those areas, converting business there, knitting it with our digital sales process. These are certain things which we believe that we have created a niche for ourselves, and we would be able to generate the business that we desire, irrespective of how the market goes up or down. So in short, what I'm trying to tell is that there is a captive capability that we have created, which we are very confident that at least next 2 to 3 years we would be able to generate our top line.
All right. And in terms of geographic diversification, Kerala would be what part of our loan book, Kerala and Karnataka now?
South is about 83% as of 31st March, of which Kerala could be in the range of 50%. Karnataka would be about 10-11%. You should see that number coming down, like Madhu replied to somebody else some time back, that number should come down significantly as we go ahead.
All right. So yeah, I think that's it from my side, and there are no questions in the queue as well. So we could very well close this call. So thanks everyone for joining, and thanks to Vinod and Madhu for taking out time. So I think everyone, you can have a pleasant evening, and thanks Leo for hosting us.
Yeah, thanks. Bye-bye.